it would be interesting to go around and say, again, some of you have touched on this already, and to get your views in the vertical that you're currently working in, what you think the next big thing will be. It's quite a broad church, so you have as much latitude as you want, Sean.
Okay. So I do think the digitalization of everything is happening as we speak, and lots of regulatory regimes are now looking at how they can set up structures to protect consumers and businesses that engage in this space. I think the big thing that will happen is what I see, the transformation of the capital markets. So there is a lot of, I would say, underfunded businesses in the SME space where they cannot raise debt or equity because of, again, regulation. Often capital requirements have made banks in a position where they can only lend or interact with bigger companies. And if you can offer a digital bond or a crypto bond or a digital equity or a security token, as some people call them, you can cut the costs of raising capital or debt materially. And if there's a way of listing these instruments that you can have a safe way of interacting with them, you could inject liquidity into the system in a way that I think is highly overdue, particularly in the West, where there's a lot of small businesses that aren't getting the funding they need. Crowdfunding has moved in some of this direction, and I think a lot of people are going to the crowd to raise, potentially for ideas which are a bit too risky for the common consumer. But I think if people do this intelligently and in instruments that have in mind protections for the consumer and for the investor, this could be a material transformation in the coming years.
So for you, better ways of debt and capital origination, debt and equity capital origination.
And secondary markets.
And secondary markets.
Yeah.
Yeah, secondary market, that's a good point. Okay, great. Mike?
Yeah, I think I just stay on the idea of a leap forward in kind of automated tools for decision making. And I think partly related to this idea of kind of the retail market becoming a bit more institutionalized. So essentially retail having more access to information and tools that were previously the preserve of the kind of institutional space. So I think that kind of democratization and transparency is just going to continue.
So if you're an ultra high net worth individual who enjoys the exclusivity of having your kind of quasi-institutional service where you can talk to somebody who's sitting on a trading desk, or think you're talking to somebody competent who's sitting on a trading desk, what's going to happen to all of those clients? Because they are responsible for a large chunk of the revenue that wealth managers make, and like it or not, they like the feeling of exclusivity.
Yeah, I think the bar's just going to go higher in terms of AUM level that merits that kind of service. So,
Okay. Andrea, your space?
Yeah, so payment space. So I think there'll be a much more consolidation of payment companies. We're already starting to see that in across UK, Europe, and we've seen that in the US. But I think much more focus around value adds. Unfortunately, the days are gone for businesses like mine where we could just rely on payment transactions. It's now all about value adds, and we're all scrambling to build as many as we can, as quickly as we can. So it's value adds, it's data-driven products that our retailers and merchants want to see and what they want to pass on to their consumers. So I think really that's where everything's going at the moment, and endless automation. Always automating.
What would... Payments not really my space, so what would the killer product be?
Oh God, the killer product for me right now would be around much more insight around some of the declines that some of the merchants see.
So insight rather.
Yeah,
okay.
It's much more insight, I think.
Rather than transactional processing.
Yeah, I like transactional processing. That's where we made the money, but it's
race
not,
to the bottom now.
It is 100%.
Yeah.
It's a race to the bottom. So it's much more around the data-driven products that we can layer over the top to give our merchants much more insight, so that they get less abandonment, and much more uptake from their consumer base.
Very interesting. Alex?
Well, I would certainly echo your Andrew's points about sort of the data-driven side of things. If you look at the whole sort of capital markets chain, you've got the fund managers, I would argue that they take a whole chunk of your money when you're investing your money. You've got the broker dealers who are probably taking a chunk of it as well, unless you're going through an execution-only platform, in which case you're paying for it on the spread. Then you've got the whole sort of custody network. Where do you store your assets, and where are those kept, and who's your nominee, and so on. And or if you're an institution, how much money are you paying your agents? And then you've got the sort of the clearing and settlement bit, which is kind of the bit we do at the bottom. Our costs are very, very small indeed. If you look at that whole stack, we represent less than a bip of that whole stack. It's just tiny. But we do a lot of volume, right? So we've got to work, and if we don't work, then it's a real problem. What can we do as an organisation? We can say, okay, what we'll do is we'll look at the data that we've got. We have a lot of data. And actually, are we using that data effectively? No, we're not. So how can we use that data more effectively? We can do a lot more data analytics on it. We're starting to do that. We're even starting to use AI in quite a rudimentary way. Let me give you an example here. So, we have hundreds, thousands of people who trade, and then they settle. Okay, I mentioned the 19 banks, but there's lots of other organisations who aren't your settlement banks, who are party to the settlement. So, for example, your pension fund would have an account, and might have an account with us, and they'll trade. And so, the question is, can you see how much when settlements don't work, when they fail, right? We have I think in equities we have like a 93% success rate. I think that's right. So 7% of equities, which equates to however many billion each day, don't settle on time. And the reason they don't settle on time is because of the information is wrong, right? And if you some of our sort of bright guys have looked at this, and they've come up with some data analysis on it, and they've looked at it. They've used some pretty open tool sets, TensorFlow, of course, on the AI, and they've come up with this this algorithm, or this app, if you like, which will allow you to see, when you're likely to have a settlement fail. So that's a great opportunity, So hopefully we as an organisation can get some extra revenue. We can sell it to our clients, and we can say, well, look, guys, hang on a minute. You realise that when you're dealing with this counterparty on this kind of security, your failure rate has been quite high. So, and given the sort of the current what's currently going on, the regulations are really, really forcing up. And I don't know if I'm sure. Regulations are an opportunity and a threat, but they're really forcing up the cost of doing trading and settlement. So if you've got a settlement fail, you will pay as of September next year an awful lot more for that fail. And so if we can provide them the information so they don't fail, and they sort it out before they actually settle, that would be great. So
it's not just
use of AI.
Yeah, it's not just it's not just that cost, it's also the fact that you've got to have lots of people in operations running reconciliations.
Absolutely.
The rest of it.
So it saves us money, it saves our customers money.
Exactly.
We hopefully will charge a small price for that and get some more revenue from it. And then, if I look at it from the point, from my sort of side of things, the way I sort of see things is when I look at it from a technology perspective, there are a few things that are, a few trends, if we call them those. You've got increased cyber threat, right? So cyber security is a big, big issue. You've got data analytics, artificial intelligence. What can you do to exploit that data? You've got DLT, blockchain, crypto assets, all those sort of market over there. And you've got sort of process automation through some of these robotic process tools, right? So we look at all of those, and we think, where can we use them in our space? And we're using some RPA. We're trying to make our operations more effective. But in my view, RPA is a sticking plaster. It's usually saying screen scraping. It's usually saying take data out of here, out of this system, and then stick it into that system, and that sort of thing. So it saves an operator and it saves costs that way. We're looking at artificial intelligence. I've just given you an example. We're very much looking at the whole blockchain DLT side. We don't see it being a core threat whatsoever. However, we can see spaces where we could use that technology in some other areas. Crypto, we'll have to see, quite frankly. I mean, will that gain traction or not? I'm not necessarily, I think ultimately it will. When central banks start issuing crypto, that would be great. The European Central Bank told me yesterday that they certainly won't be doing it anytime soon. And then there's cybersecurity, and cybersecurity is a real threat, right? So the number of attacks any organisation has is rapidly increasing. It's really increased over the last sort of few years. It hasn't changed a lot from last year to this year, but you can just see that all you need is a nation, state nation threat. Typically, we've seen it from the east coming, and if they decide really to do something, they could do an awful lot of damage, and they could actually breach systems.
Well, that's the counterpoint to the cost of technology going down is that
Agreed.
There's increased there's increased threat, right? So that's
quite
a
right.
quid pro quo, I guess.
So I would say that the technology costs, if you're developing new stuff, is going down. But the problem is, for most organisations, they don't get rid of the old stuff quickly enough, right?
Yeah, that's a good point.
So you've got to get rid of the old stuff to reduce your cost.
Yeah.
And then you've got to deal with the increased cyber threat. And
Yeah.
you're absolutely right. I mean, we're spending an absolute fortune on cyber security, as are indeed most financial services firms. I work with, I know the CTO of an asset manager called Schroders quite well, and they spend a lot of money on cyber security because they're worried about it, and they can see that it's a real challenge for them. So that sort of thing is really interesting. But then you start to look for solutions in that space, and a lot of the solutions are actually driven by some of the newer technologies. So you've got, I was working last year with a very interesting company which came out of the US Air Force, which effectively helps you with your identification of cyber threats. And what it does, it's like you buy the software, you plug it into your network, and it just sits there monitoring the network. And it's got a whole load of machine learning built into it, and it's trained on some of the threats it's getting. And so it sits there monitoring your network traffic. And really all it's doing is saying, okay, where is there anomalous network traffic? Where are things not as they should be, based upon our historical evidence?
Yep.
And then it learns from your own network. And then it allows you to then, and then comes up with, okay, possible, breaches before they happen. And that's really important. That's really interesting. So, I mean,
Great.
none of us want to be here when, I don't want to be, CTO if WannaCry hits again or something like that. That's I know several CTOs have had to deal with that, and that's quite hard, right?
All right. Very good.